Is Corey Dayharsh. There we go. Hello, everyone. My name is Corey Dayharsh. I am with Advanta IRA, and I am here to moderate today's presentation on the 2026 New Year, New Investments general topic. So today I've got great panelists. We've got Bill Green, the principal and co-CEO of Ginkgo Vest, and we've also got Dixon Bradbury, partner in LSX Capital Management. Gentlemen, thank you so much for joining me today. I'm really looking forward to the great education that you each will bring about your various industries and respective investment opportunities and some things that people should know about as they look forward to 2026 and where and how to invest.
Thank you, Corey.
Thanks, Corey.
So just to give you guys in our audience a little bit of background as to why I'm moderating. Again, I work with a company called Advanta IRA. We're a full service self-directed retirement account administrator. So what that means is I'm an expert over the past 10 years in how people can use their retirement accounts, whether it be an IRA or a 401k, into alternative asset investing. So outside of stocks, bonds, and mutual funds, you can invest into various asset classes with a self-directed account. And that's kind of why I'm here moderating today's presentation. We've got Bill and Dixon who are going to speak about their respective industries of investing. And these are things that you can do with a retirement account. You just may have not known so. And it's a really easy, simple process as well. It takes about a week to a week and a half to get your money moved over from your existing retirement account into a self-directed retirement account. And from there, you pretty much have the control of your retirement dollars in your own hands to make any unique investments you would like. So that's the baseline of what I'm here to talk about. I'm not going to take up much more time, but if you are interested to learn more, please feel free to reach out to me directly. I'll be very happy to answer any questions you have and possibly help you get a self-directed account set up. Without further ado, what I'm actually going to do now is turn over to Bill. Bill's going to cover some basic information about Ginkgo Residential and some views on his aspect of investing, which is real estate investing. And then after that, we're going to go ahead over to Dixon. But real quick, before I let Bill start speaking, I do want to let you guys know we want active participation today. So I am moderating. I'll jump in and ask Bill and Dixon various questions as we go. But if you guys use the questions box in the Zoom panel, I will be moderating and interjecting with those questions as well. So please feel free to find that questions box or Q&A box and use that freely. I have that up on my screen, so I'll be able to interject with your questions as we're presenting. Bill, the floor is yours. Go ahead and take it.
Thank you very much, Corey. Ginkgo Residential has been around for about 40 years in some way, shape, or form. And during that period of time, we've been public, we've been private, and we've been part of larger capital plans, but we've always been focused on workforce housing in the Carolinas and the Southeast in particular. What I can say about the multifamily industry in general is over long periods of time, the multifamily industry is historically one of the best protective instruments against inflation. It tends to appreciate from a rental perspective and ultimately a value perspective in correlation to inflation plus about 3%. This is over, generally 5, 10, 15, 20, 30 years. And what's interesting is even during short periods of hyperinflation, rents actually do catch up fairly rapidly because rents reset. So my expertise is more in North Carolina and South Carolina. As a company, Ginkgo is focused there, but a lot of what I'm going to tell you is multifamily in general, real estate overall. What we are is we're a pure play North Carolina and South Carolina company. We have about 8,000 apartments that we own or own in joint venture in North Carolina and South Carolina in REIT format. And that's really what my expertise is from. What we're seeing right now, though, is rates are normalizing, interest rates. And interest rates and real estate is very correlated. People are buying a fixed income instrument. So like a bond, it will adjust relative to changes in interest rates on a value basis. So you had a period of approximately 2.5 to 3 years of expanding rates and higher elevated rates. Rates do look like they're actually coming back into more of a normal historic range for right now. As a result, the underlying valuations for real estate are also coming into that same correlation where rates in particular and capitalization rates that people buy at were uncertain, people are feeling a lot more comfortable with where the rates might be going right now, believe it or not. And as a result, volume and activity is picking up, which is actually stabilizing things. With it, we had substantial rent growth. We as an industry, but also the Carolinas in particular, and Ginkgo, and in addition to that, we had very substantial rent increases during the period of 2021 through 2023, in correlation to the hyperinflation that took place for a while. That's actually getting back to more of a historic norm, and we're seeing projected rent increases probably in the low single digits from what had been in the high single, even low double digits for a while. But what's starting to offset that is a few things. Is now that rates are stabilizing, things are actually coming into fold. What we're seeing is we're seeing these strong fundamentals from an occupancy and a collection perspective are being offset now by supply that has actually come into the market. Uh, Investors, particularly developers, saw the opportunity. They saw the rising rents, and as a result, they do what's not uncommon, and that is they overbuilt the supply a little bit in really throughout the Southeast. But that is now coming to a peak, and it's actually starting to pass, and we expect that to start to pass in 2026. But with it, again, we take the long-term approach. We look at this as a very simple business model. It's an inflation-oriented model with modest leverage. It's an inflation plus model. And in the Carolinas, we have a unique aspect, and that is the Carolinas are generally the top 2 to 5 rent, rather relocation states in the country on a consistent basis. The net in-migration accelerates during periods of weakness in the economy. It actually maintains during periods of strength in the economy. We have sufficient land and supply that makes the Carolinas affordable. So as a result, we have positive demographics. We have an inflation-protected industry, and overall, we actually think this is probably a pretty good time to have interest in multifamily if you have not. Over the last few years, even though at Ginkgo in the industry, our rents were up almost 25% over a 3-year period. Cap rates actually expanded by slightly more than that. So our values went sideways. We actually see that now starting to reverse, and we actually think this is a really interesting time to invest. So for us as a company, we're actually looking to invest again, as are others. And I'll stop there.
Yeah, Bill, I've got a few questions for you just based on some of the information you shared there. So, if you could, from your side, help me break down for the investor in the audience what this looks like as far as investing. So, they're not technically investing directly into the real estate, they're investing into what we typically refer to as a syndication or a limited partnership. Can you break that down from your side, how they would source their general partner, their Ginkgo Vest? And you mentioned sometimes you co-GP with other groups. So are they needing to do due diligence on these other groups as they're deciding to invest with you? Can you just kind of break down some of the basics of that for an investor standpoint?
Sure, those are good questions. We operate predominantly out of an enterprise called Ginkgo REIT. Ginkgo REIT is a constantly issuing but not publicly traded REIT. And so therefore, we maintain a two-way market. When people want to come in, when they go out at a price. Our values and our portfolio are evaluated quarterly so that you're always getting the intrinsic value of the underlying real estate. Where in public markets, you have things where companies trade above book or they trade above intrinsic value. And so there tends to be a lot of volatility in the non-traded space because you look through to the asset. It's a much more reliable long-term valuation. As a result, you can achieve the same returns without a fraction of the volatility that makes you want to pull your hair out. From a joint venture perspective, we do joint ventures in 2 ways. First of all, Ginkgo REIT ends up becoming the general partner in the joint venture. So in all cases, Ginkgo REIT can actually get outsized return, and that is if the asset we joint venture with becomes a success above a certain return, Ginkgo REIT would actually get disproportional returns. And so let's just say we have a transaction where Ginkgo REIT might own 10% and a syndication of 2 or 3 people or larger or a single investor might own 80 or 90%. We in turn, and let's say we have a hurdle at 10%, we would own 10% of the income above, a 10% until we get a 10% return. But once the return goes above 10%, it's not uncommon for our side to go to 25, 30, or 40% of the upside beyond that. So the REIT actually gets the benefit. Relative to who our joint venture partners are specifically, it can be really, well, one of two structures. We have some household and relatively household names that we joint venture with. In 2025, when we started to buy assets again, we did 7 joint ventures with JP Morgan Asset Management. So we are promoting JP Morgan Asset Management as the REIT if we're successful. But we also do, sometimes we will do sidecar syndications with our REIT investors where we'll actually, if people want to double down into an asset, et cetera, we will actually go to our REIT investors and give them the opportunity to do that at times.
And another question, just again to relay some basic information to the audience. When someone wants to invest with you, what are they looking at in terms of typical timeline for the investment from the day they fund it until that investment goes full cycle? What type of expected or projected returns on average are you guys looking at for this asset class in this space in investing?
Sure. So the current dividend is 5.6%, and that is paid monthly. And so once you get through compliance, you can come in on a monthly basis. And that 5.6% gets reviewed quarterly at the board level to determine if there's a change in the dividend. Then when the day you come in, you have whatever your investment is relative to the entire capitalization of the company. You would now own that fractional interest in the 8,000 apartment units that we own, wholly or in joint venture format. Um, then from an exit perspective, you actually get the opportunity to exit when you want to exit. We do quarterly redemptions. Those quarterly redemptions take place again at whatever price we're offering stock at is the same price we're buying back at. And in what we do though to actually cover our costs, we actually have a soft lock. So in the first 12 months you can't redeem, but anytime after the first 12 months you can redeem. But there is a small penalty. 5%, 4%, 3%, 2% for the subsequent 5 years. After that, it's at par. And what that does is that actually just reimburses us for our capital raising costs, et cetera, and you stay in the transaction. So what it is unlike in the stock market, where if you own a public REIT stock, you have daily liquidity, but the reality is most people don't sell when the stock is at a high price. They actually sell at a capitulation price. And if you look at the volume of sales, of the volume in the stock market, volumes are highest on sell-off days, and they're very low on all other days, including large gain days. But when they actually sell in a capitulation. In ours, you may have a 90-day delay, or 180 days from when you start to think about it. But the price is so stable that your price is a little more certain, and so getting out is still, it's up to you, and your price is fairly well range bound.
Awesome. And we did get a question that came in from the audience as you were answering that. And again, to reiterate for the audience, please use the Q&A box to ask any questions. I will be relaying them to our speakers just to make sure you guys are getting the questions answered that you actually have. I'll always try to throw something in just based on my knowledge, but it always helps to actually hear directly from you, our audience. First one here, as a second one just came in. Does Ginkgo Residential own any properties that don't make it to Ginkgo Vest?
No, everything we have, either Ginkgo REIT is an owner of the equity entirely, or it is the owner of the GP in the equity. We have 2 legacy investments that predated the REIT's formation that will be coming to an end shortly. But interestingly, we've had investors who were in some of those transactions who've contributed their interest to the REIT. So the REIT actually does have interest in one of those assets already, which we may or may not buy when the time comes, and that asset will go full cycle. You asked about returns, and I forgot to answer that. So over the last 7 years, the REIT has paid a total return of approximately 11%. And to put that in perspective, Stanger, an investment bank, actually runs numbers and runs comps against us, against all publicly traded and then publicly non-traded housing related stocks. And we're actually the best performing REIT in those categories in the country over that period.
Awesome. Another question that came in, are there capital calls?
There might be capital calls within the joint ventures themselves, and the REIT takes care of that. But once you put your money in the REIT, it's a one-way that we have no legal capacity to ever make a call to you. You only have a legal capacity to actually ask for your money back when you want.
Got it. Understood. Well, Bill, we will come back to you in a little bit once we go full cycle. At this point, I'm going to go ahead and turn it over to Dixon Bradbury, who again is from LSX Capital Management. Dixon is a little bit of a different investment space. So, Dixon, why don't you tell us a little bit about LSX and what you do and what investment opportunities you guys provide?
Yeah, thanks, Corey. And thank you, Ginkgo, Rada, and Bill, for hosting us. There's a lot of similarities between life settlements and real estate, so I'm excited to dive into that. For those of you who are unfamiliar with what a life settlement is, the basic definition is the acquisition and transfer of a life insurance policy for cash or RDV. And really, what that means is someone who owns a life insurance policy is looking to sell, trade, or transfer that life insurance policy in exchange for a lump sum of cash. And so who we are, LSX has been in the space for going about 12 to 13 years, the asset class itself having been around for about 110 to 120 years. LSX, we provide the supply, the underwriting, and the acquisition and closing services for closed end life settlement offerings that we bring to market. To date, we've got about 20 different offerings that we've brought to market that are under active management. And so our goal is really to just democratize this asset class and really bring about an awareness to it. And so one of the first points that I kind of wanted to bring up was this increasing market visibility that we're seeing in the life settlement space. For many of you who might watch late night television, you're probably seeing an increase of advertisements through some of our partners and competitors in what we call the origination space. As in 2025, we saw a record direct-to-consumer ad spending. They're going to be posting those late night commercials saying, if you want to sell your policy, call us now. And one of the things that we love about this marketing effort that a lot of our partners and competitors are both doing is it's really a double-edged sword. The very first is it's increasing the supply in our industry. As those advertisements go out, those individuals call in, we get additional supply that we get to underwrite and value. But the other side of it is it's also intriguing a whole new wave of investors, people who see those advertisements who might not be in a position where they need to sell or want to sell a policy, but they might look to try and get involved in the asset class. And so we're seeing a simultaneous increase in supply and demand to be a part of this happening at the same time. And so to give you kind of a breadth of what the life settlement industry looks like, a recent report by Conning, who's a research institute, says that the estimated gross value of life settlements is set to be somewhere in the neighborhood of $220 billion a year. Last year, I think there was roughly about 3.6 billion in transactions that occurred. And the average estimate is based on Conning's report is going to be somewhere in the $7 to $8 billion a year range sometime within the next 10 years. So there is quite a breadth of activity that's going on in this space, and that's only reaffirmed by the 2024 transactions that showed over 22,000 different policies were reviewed for sale. And of those, about just shy of 3,000 were actually transacted on. So this increasing market visibility is really what's driving this positive investor sentiment that we're seeing. Within this space, there's been a lot of what I'll say, quote unquote, professionalism that's been coming out year over year. We're seeing standardization across the industry through submissions. We're seeing it through servicing protocols. We're also seeing it through LE and medical data reviews. And so all of this put together alongside of the fact that there's consistency in the licensing procedures for brokers and providers in our space is giving a lot of institutions and retail investors the comfort level to jump into this more nuanced and niche investment. As far as kind of what that means for the greater accessibility, the same Conning research report that came out showed that right now, while this asset class was previously kind of reserved for the ultra high net worth, you saw larger pension funds, hedge funds, names that you might be familiar with like Warren Buffett or Bill Gates participating in this space to a high degree. We're also seeing this trickle down that's now reaching even the retail investor. And that's kind of part of what LSX's mantra is. 27 to 30% of the respondents to this most recent survey actually managed $100 million or less. So we're seeing this greater accessibility across the market. And what that's also doing is as we continue to reach out to the broader space, we're seeing again that increase of supply and demand kind of increase or inch up simultaneously. As far as kind of what that means for the investors, well, the investors are looking at it as a win-win because again, more supply, more demand, increased volume, increased accessibility for again that retail investor. So
And
one of the okay,
Dixon, just real quick, regarding that supply and accessibility, how does LSX source your potential policies?
yeah, great question. So in our space, I'll use a comparison to real estate. In our space, you have someone who's an end seller of a product, of a life insurance policy. And just like someone who would like to sell their real estate, their home reaches out to a real estate agent, we have in our space what's known as life settlement brokers and providers. They're both licensed at the state level, and LSX works as really an aggregator of the supply. So we don't work with just one broker or one provider. We actually work with the entire market so long as they'll work with us. And what we see is on average, we're reviewing about $500 million worth of unique face value per month, which can equate to anywhere from 300 to 500 unique policies. So we really work with the entire market. We estimate we have roughly 2,000 direct and indirect supply sources, of which I'd consider about 25 to be our key suppliers. So, as we kind of
What's the profile? Can I, what's the profile of the average seller? What does that person generally look like? What are the circumstances that say, hey, I want to sell this asset?
great question. So we really boil it down to someone who doesn't want, doesn't need, or can't afford their life insurance policy. One of the recent stats shows that in 2026, there's going to be roughly 11,400 individuals in the US who are going to enter retirement age a day. When you start to think about someone's state of their life at the moment, when you first bought life insurance, it was seen more as a peace of mind product. You wanted it to cover kids' college, you wanted it to cover a mortgage, you wanted it to provide a safety and security blanket for something at that point in time. On our exchange of the 300 to 500 policies a month that we review, the average age of a policy is about 16 years. So if you think in terms of each one of our individual lives, where you were 16 years ago, your wants, needs, and that which you were looking to protect has completely changed. So these are individuals who maybe they're entering retirement age, they're on a fixed income, they can't afford the premiums. They're individuals who that thing which they bought life insurance for in the first place, that desire to protect something has been satisfied. So we see on average, the average age being about 77 years old and the average duration they've owned the policy being about 16 years.
Great, thank you.
Yeah, absolutely. So as we look at this increasing market visibility within the life settlement space, one of the things that is really also driving the investor side of that is this investor sentiment. And right now, the investor sentiment in the life settlement space is about as high as it's ever been, and that's primarily driven by this uncorrelated nature of life settlements. It's not tied to any financial or economic markets. And it's also tied to this resilience that we'll talk about in just a second, whether it's an economic boom or a lull. And so, going back to that investor sentiment, I was talking a little bit about how right now you're seeing a greater accessibility, a democratization, if you would, down to the retail investors. And one of the things that I think is the most striking about some of the data that's come out in recent months as it relates to players in the life settlement space is that in 2026, over 50% of surveyed investors or members of a life settlement portfolio have actually said that they plan to increase their exposure in life settlements by 1.5x or greater. So we're seeing this desire right now for something different than the traditional equities really play out based on some of these benefits that life settlements see. And that kind of ties to this resilience bucket, just much akin to how Bill was talking about how this multifamily, especially in the Southeast, has this ability to really help prop up a portfolio and carry it during economic lulls. You're seeing the same thing within life settlements. We're in what people are considering right now to be this alternative boom. Alternatives are really the buzzword right now. And one of the biggest reasons for that is there is a little bit of yield pressure. While interest rates are slowly coming down, there are some higher interest rates, but we're seeing the spreads across traditional equities and traditional investments start to tighten a little bit. And so life settlements, which fits in this alternative category, but also sits parallel to kind of this private credit. And as if you follow a lot of the different alternatives spaces right now, private credits, wherever all the money was flowing in order to kind of chase that yield, we're sitting kind of in between the two, where people are starting to realize the potential yield in life settlements, the kind of tagline that people use is it's equity-like returns with a bond-like risk, with low risk. There's little to no volatility because in life settlements, when we buy a policy, we know what that end value is going to be. So the real determining factor is, well, what's the longevity risk? How much can you buy it for? And what's that ongoing carry cost? So people kind of view this as structured, almost a structured income type investment. So, and then,
Um, I'm sorry, a question just came in from the audience if you'd like. Yep. So, with the increased growth in this sector, do you see the market being compressed and policies becoming more expensive, or a higher rate of policy, quote, gathering to increase supply?
great question. So kind of it's that stair-stepping elevator approach I was talking about earlier. If you go back to the number 11,400 individuals that are set to enter retirement age a day, I think one of the biggest stats inside of that is right now it's estimated that 55 to 60% of the individuals entering retirement age are going to fall inside of what we call this readiness gap for retirement. And so I think there is going to be a larger push on the direct to consumer origination. So you're going to see a lot more advertisements. You're going to see some consolidation in our market where some of the smaller players who previously relied on solely that broker and provider network are going to start to merge and be acquired by some of these direct to consumer companies. But one of the things that you're going to see is as the supply continues to increase, because that 60% of the 11,400 a day are looking for ways to really prop up and kind of cushion their retirement, that increase in supply is actually going to keep returns roughly steady across the next 10 to 20 years in this space.
Awesome. And
With,
I
with
think you
inflation,
go ahead,
with,
Bill.
yeah, with inflation, are policies getting bigger? Are people buying bigger policies?
Great question. And I'd like to give you a straight answer, but really what it comes down to is life insurance companies do some vigorous underwriting, not just on the health of the insured or the age category, but they also do some credit checks. So as inflation goes up and as we see the rise of kind of this gap between low income, high income, the spread of policies is actually staying roughly the same from what we're seeing as far as submissions on life settlements. I can't speak necessarily to the introduction of new insurance because I know for my generation, if someone asks me, Dixon, what type of insurance should I buy? I'm going to tell them get a 10 to 20-year term policy, something that's going to cover your security needs as of today. The policies that I know a lot of my colleagues are buying are higher in face value than I think what would have been purchased 10, 20 years ago. But those policies are also ones that, as we're buying today, aren't likely to be life settlement potentials down the road.
Okay.
Yeah.
And Dixon, before the question came in from the audience a few moments ago, you hinted at some of the risks associated in this asset class. Can you just expand on that a little bit further for our audience? What are the primary risks associated with investing in this asset class?
Yeah, great question. And so, kind of to the tagline you see on the intro there, it's a return strategy built on underwriting and time, not timing. As it relates to some of the larger risks in this asset class, one of the ones that we see as kind of that primary risk is longevity and mortality. We can do financial underwriting, dissect a policy, and while the financial underwriting is equally as important as the medical, we can grab a pretty good understanding on that financial underwriting just by digging through the policy documents that come through, the policy copy, et cetera, and stay on top of the financial side. From the longevity side, that's where the collection of data and kind of understanding what that data means is so important. You take, for example, some policies that we might purchase with a 5-year projected duration. That 5-year projected duration, what you buy it for is going to be key because at the end of the day, what you buy it for is really going to be driven. The return is going to be driven by how quickly is that going to pay out. So the longevity risk is definitely the primary risk factor. And one of the things that I think has been great for our industry as far as the risks are concerned, I mentioned earlier the standardization across really the licensing of brokers and providers. There are 46 different states in which life settlements are regulated in part or whole. And one of the things in each one of those states that LSX looks to do is providers, which act as kind of the closing department, if you would, for each transaction. LSX has a closing team that works hand in hand with those providers to make sure that all the contracts are properly done. And some of the due diligence that we do can go as far as med fraud reviews to reviewing the initial application for life insurance to figure out, okay, when they said they were healthy, were they? Is there any reason a carrier could come back and contest the claim? Getting spousal sign off, beneficiary sign off, getting all these documents notarized, because at the end of the day, our goal with our investors is create something that's turnkey. Money goes in, money goes out. There's no delay based on something that didn't happen during the due diligence process.
And to that effect, with money in, money out, you really led me into my next question there. What typical returns, just as I asked Bill earlier, are an investor looking at in your asset class?
Yeah, great question. The life settlement industry as a whole has a varied range of returns. I'll say the concentration of that comes into about that 10 to 12% range. And that's what you find a lot of open funds are kind of more towards the lower end of that. That open-ended structure is one where the life settlement industry has seen they're still trying to figure it out given the redemptions and the illiquidity of this asset class. LSX focuses on closed-ended funds. And if we had 2 hours, I could really dive into the nuances between the two. But by focusing on these closed-ended funds, LSX is actually able to really actually increase those returns. We're seeing across the 20 funds that we currently have under management an average of just over 16% annualized, and that is net as well. So we're able to outpace the market based on what we're seeing as the traditional life settlement returns.
Awesome.
So, and the kind of the last part that I'll talk about, because we are talking about life settlements, which by nature has a more morbid factor to it, is this socially responsible? And one of the things I talked about earlier was 11,400 individuals in the U.S. entering retirement age per day in 2026. 55 to 60% of those being in this readiness gap for retirement. Well, when a seller participates in a life settlement transaction, we really call that the tagline is it's a living benefit. We give them something for nothing. There's currently $20 trillion of life insurance in force in the United States. That's spread out across your group policies, term, whole life, other permanent types, subtypes. Of that 20 trillion, only about 8% of it is actually expected to pay out. And that's because people don't realize what they can do. They drain the cash value. It's then worthless. They throw it away, or they just can't afford it anymore. They throw it away. And so what we're able to do is we're able to, as we make an offer, transact on a life settlement, we're able to provide them a lump sum of cash that helps them with that readiness for the retirement factor. I mentioned earlier that there was 2,700 successful transactions in the life settlement space in 2024. While a large number of those are in the business to business, the tertiary space, a significant number is the business to consumer. And one of the things that we actually noted was in 2024, there was just over $600 million paid back to consumers in exchange for those life insurance policies. And so those folks who are looking to sell their policy, that equates to roughly, I think the number was 6.5x over the cash surrender value that they would have been able to get just by returning it back to the life insurance company. So the dual benefit there is not only do they no longer have to pay those premiums that they might have been paying into year over year, but they receive that lump sum cash as well. So that's that living benefit that we like to talk about.
Awesome. And one other question came in from the audience here as you were finishing up that last bullet point. Are your LE calculations more accurate when you underwrite the client versus the insurance company underwriting, due to the client being advantaged to be more truthful about health aspects?
Great question. So I'll start with the life insurance side, the life insurance company side. When you first go to get a life insurance contract, that underwriting is done with your health at the time. When we view those policies, if you remember to earlier, I mentioned we see them about 16 years after they've been in force. Our underwriting process, we actually gain access to given to us by those looking to sell their policies, full prescription drug screens, lab diagnostic reports, all attending physician statements, and medical records. So we actually are able to look at a person at the time of sale versus the life insurance company who's just looking at them when they're looking to get the insurance. I know most of us would say we're not the same person today as we were 16 years ago. And then furthermore, when those life insurance companies are doing the initial underwriting, what they're doing is taking it more in a group of 1 to 1,000. Unless you're going for one of those ultra high value policies, 5, 10 million or more, or you're someone who already has pre-existing conditions, they're just looking at various factors such as age, gender, demographic, etc. Whereas what we're doing is our underwriting takes really almost a 5-step approach before we actually get to the point where we're willing to offer on that policy. Of the 5-step, we run 3 separate life expectancy reports before we're actually to the point where we say, hey, we're going to do this.
Awesome. I am going to move forward to just the slide here comparing real estate versus life settlements. There was one other question, Dixon, that came in as you were providing that answer for the last attendee. Are these policies protected from creditors if the policy holder has credit issues or develops credit issues while they are still living?
So in short, yes, anything that we'll buy during the due diligence process, we will clear up any credit issues that might be present, or we will not transact on that policy. When we go to buy the policy, we buy it outright. And what we do is make sure that what we're buying is clean and understood, because again, our number one goal is once we purchase the policy to then get the funds back in the investor's hands once the policy matures.
Perfect. So again, here on the current slide, we're talking about comparing and contrasting real estate versus life settlements. Bill, I'll come back to you. Pretty much with real estate, there's, green check marks on all of those attributes. Can you just highlight maybe the top 2 or 3 that an investor would or should be looking at as far as considering making a real estate aligned investment?
Sure. I think the one thing I would say is while real estate itself is illiquid, in a non-traded REIT format or in a public REIT format, what you've done is you've actually liquefied. You do have the capacity for your own liquidity, so that while the underlying real estate is actually fairly illiquid relative to the life cycle of that investment, when you actually are disintermediated through an entity that owns a portfolio, you actually do gain liquidity. So I'd ask you to think about that if you were to think about us. But I do think, again, the most important thing with real estate and with multifamily real estate in general is its cash yield potential, and that is it should generally grow in the multifamily space. If you're in growth markets over long cycles, it should generally grow in excess of inflation. And it should grow historically about 300 basis points in excess of inflation. And so, for me, it's really that part of your portfolio where you say, what do I want as an inflation hedge? I don't control certain things, et cetera. And inflation is one of those. And so for me in my portfolio, I've always been attracted to real estate. I was a banker for a long time, but I've always been attracted to real estate for that element. I would just say it's inflation protection is really the most important.
Awesome. Thank you. And Dixon, again, to compare and contrast life settlements to real estate here, there's the 2 X marks and the kind of triangle with the exclamation point. Can you expand on what those really mean in comparison and contrast, and where the life settlement market picks up for not having those same comparative factors?
Yeah. So as it relates to the correlation to the equities market, life settlements are viewed as one of the only true uncorrelated asset classes. Your investment in life settlements is not tied to any shifts in the economic or financial markets. When we buy a policy, we know what the end value of that policy is going to be. The determination on your return level is going to be how long it takes to receive that benefit. And so no correlation to equities. As far as inflation linkage, much like Bill was just saying, Ginkgo has really an inflation hedge. Where life settlement comes in is, while there's no quote unquote inflation hedge within life settlements, it's that uncorrelated nature to the markets that really kind of helps to offset that. And then in our industry, it is very rare that you'll see someone use leverage in order to purchase these. The way that our funds work is it's very direct. Capital is raised, capital is then deployed into those assets, and then really again back to that turnkey kind of set it and forget it mentality.
And Dixon, that actually brings me to a point. I asked Bill a question earlier that I had not asked you yet. For a general investor in the audience today, how would they go about the process of investing with LSX? Is it a subscription document? What type of investor agreement and process would they go through?
Yep. So each one of our funds, it's really a template, rinse and repeat. We have a private placement memorandum as well as a subscription agreement tied to each fund. Funds run roughly twice a year. We'll open and close them, and it's a very straightforward process.
Perfect. All right, gentlemen. Well, we're gonna go ahead and move on here to our final slide with all of our contact information for the audience. Um, I will allow a few more minutes for people to add any questions, but as we're waiting for those questions to come in, it's a great time to just ask you guys, what type of opportunities do you have right now for investors to jump into? Bill, I'll start with you. Is there anything hot and on the press over at Ginkgo that investors could really jump on if they were interested today?
There's three things. We predominantly issue straight equity, and we have monthly closings for that. But we also have a serial notes program where we at the REIT level, we actually got rid of our line of credit. We had a national bank that had a line of credit to us that we actually had underutilized. And what we did is we actually came out with a notes program where we priced it at the same basic yield as what our line bank was doing, and we've issued it retail. And so on a quarterly basis, we come out with 3-month, 6-month, and 12-month notes at basically 200 basis points over whatever the 3, 6, and 12-month SOFR curve is. So you're picking up basically bank lending rates, which is much higher than CD rates and other things. Additionally to that, we have periodically issued preferred. We're about ready to come out with another preferred program, which is also at the REIT level. And then lastly, and these are correlated, for our existing REIT investors, we oftentimes will carve out a sidecar piece in our new transactions. And we expect to have an active pipeline this year again. We did not purchase from 22 to 24, but in 2025 we bought on 8 or 9 transactions, and this year we have 2 that are already set up for purchase. But with it, we'll typically create a $1 million or $2 million sidecar that we make available to REIT investors when we do new investments. But we're also considering doing a GP fund again. We're seeing the GP market is wide open. We did it successfully, a GP fund in 2018, which is just coming to a close. And as that comes to a close, it would allow for us to do that again. So the REIT will actually be the GP of the GP fund, we expect, but we anticipate that we will have an opportunity for people to invest in a GP fund.
Awesome. So in essence, 3 to 4 different opportunities that someone could reach out to you today and actually learn more about and participate in.
They could, and as Rada will tell you, we don't want to get people too confused, but we're really happy to walk you through everything.
Awesome. Perfect. And Dixon, same question. What type of opportunities, if someone were to take your contact information from the screen and reach out today, could an investor possibly participate in with LSX?
Yeah, roughly twice a year, we open up what we call the LSX retail offerings. Those are the funds where it's a pooled investment. Investors come in for their pro rata share. We just closed our Q4 offering right at the end of last year. Our next one will be starting right at the beginning of Q2. So those are more the set timelines twice a year. And then for those investors who are looking to kind of do something on their own, they're not really interested in that pooled opportunity. We actually do what we call private funds, and that's for 1.5 million or more. You can actually build a custom and bespoke fund based on your investment objective. So while the retailer running more at specific times, that private fund opportunity is available more kind of a la carte as you wish.
Awesome. And again, just for the audience, we've got about 10, 15 minutes left on the scheduled hour for this presentation. So please go ahead and any questions you've had along the way, please jot them down and I will ask our panelists accordingly. My final question for each of you respectively is, Again, the whole basis of this webinar was looking into 2026 and growth and new opportunities. What are you seeing in your respective industry as a key point or a gleaming aspect of 2026 in the new year, something fresh that really makes your industry sparkle, if you will? And in this case, I'll start with Dixon and go to William second, or go to Bill second. I'm sorry.
Yeah, I think kind of going back to the very first point that I had, where in 2025 we saw this record DTC's ad spending. We are excited in 2026 because, especially as we're in this alternatives boom, especially as people are looking for something outside the traditional equities, and there really is uncertainty in the market, especially with the volatility that we know we've seen, whether up or down. A lot of people are looking for kind of that place to go. And so we've seen a lot of interest kind of in the overall business lines that we've offered from a retail fund perspective, and we're excited primarily to see that continue to grow and see new faces come through the door. So
Awesome. Bill?
Ours is actually one of ownership distress. It's not necessarily asset distress, but it's ownership distress. And to frame it up, there were a lot of syndication groups, oftentimes high net worth syndication groups, who purchased a lot of assets in 2020 and 2021, 2022. We've been around the block a lot. We bought almost nothing during that period because cap rates were really low, et cetera. But people were attracted to really high leverage at really low interest rates. And so you had a lot of buyers who were putting 75, 80, 85% leverage on at, kind of SOFR plus 4%. So since SOFR was only about 25 basis points, they were buying with 4.25% money, and they look like rock stars. Well, when rates went up, they fed it. They're paying as much as 9%, and a lot of them were able to come and do capital calls and preserve and kind of kick the can down the road. But what we started to find in 2025 was a lot of people couldn't do that anymore. They just, they expect, they bought on the premise of they'd be able to borrow at sub 4%, sub 5%, and at their leverage points, et cetera. It can't happen. And so we see a lot of capitulation and forced sales. Almost everything we bought last year was that, and we don't see that trend not continuing. So we think this is going to be a very active year, and the following year might be active too, at which point in time, we'll see where the market is. But there will be forced sale, which we think will be great opportunities, which is why the REIT, if we complete our GP fund, which should actually do really well too.
Awesome. So I'm not seeing any further questions come in from the audience. So at this point, I'll just share from my side. The turn of the new year is always a big time for my industry and self-directed retirement investing. People deciding before that tax filing deadline to make a new contribution, maybe move over some existing funds and get into these types of alternative asset classes. Maybe they learned about it a little bit towards the tail end of last year, and they really want to take a fresh approach into the new year and actually diversify their portfolio or even move most of their portfolio over into a self-direct account to take advantage of real estate or life settlement type investment opportunities, whereas they're otherwise in the stock market, and we all know about the fluctuation there and the dissatisfaction people have had over years. So if anyone is interested in learning more about self-directed retirement investing, please feel free to reach out to me directly. Be happy to have a conversation and teach you whatever you might need to know about the asset classes you're interested in, the types of accounts that fit your needs best, the contribution limits, how easy it is to move funds over. That is my level of expertise. And again, that's kind of why I was the moderator here, because I know a little bit about these industries, but more so I'm an expert in how you, the investor, can put your money into these various industries. Any final words from either of you to our audience as we get concluded? Bill, I'll start with you, and then we'll go to Dixon after that.
No, I just want to say thank you. Thank you for your time today, and thank you for putting this together with us.
Thank you so much. Appreciate the opportunity as well. Dixon, any final words for the audience from you as well?
I'll echo Bill's. Thank you for the great job moderating. Thank you for everyone who joined. Look forward to chatting with some of you guys, hopefully in the coming weeks.
Yep. Please take down all of our contact information. Reach out as you see fit. It was a pleasure to be here and help you guys jump into 2026 with some new information and great insights into real estate and life settlement as asset classes for investing. Your money is there for the taking and for the growing. So keep in mind, these are great opportunities, great products, and great people to work with. With that being said, happy 2026. Here's to prosperity and everyone enjoying growth in the new year. Thank you.
Thank you.